February 14, 2009. This is Maximize Utility. I want to talk about covered calls. That's an investing technique that some people say can juice your returns or get you to beat the market. It's heavily advocated by a lot of investing experts. You'll find that Business Week does a yearly article on covered calls saying that it works. The columnist James Stewart, he writes the Common Sense column in the Wall Street Journal. He also writes for Smart Money magazine. He says that he's been very successful doing it. Susie Orman has said that she was very successful doing it when she was an investor, and she recommends that people do it, or she doesn't recommend against their doing it. And if you Google it, you'll find all kinds of peddlers of services of covered calls, and you'll find all kinds of people who claim it works. I saw one covered call portfolio put up by the Value Line, and they claim that from about 1979 through 2001, their covered call portfolio was returning about 26% per year compared to 15% per year for the S&P. Yowza! That's quite rate of return. Covered calls are when you own a stock and then you write to call. I say you write to call, meaning you are the person behind the call option. You're not buying the call. You are the one granting the option. We'll describe that in a second. But because you own the stock, you are covered. You have as many shares as you have options outstanding. Let's do a quick example in covered calls. At first, understand options. Usually people buy options and somebody else has written them. Somebody else has originated them. Usually it's a bank or a financial institution. And you think a stock's going to go up from, say, 20 to 25. Well, you can get so much return if you buy the stock. But if you go out there and buy an option, maybe there's an option with a strike price of 21 that's selling for $1 or so. And then if the stock indeed goes up to 25, you can exercise your option and buy the stock for 21 and then sell it in the market for 25. And for only laying out about $1, you'll make a return of $4. Anyway, that's what people typically do. But when you do a covered call, you're on the other side. You're the one actually writing the option. You're the one who has the obligation to make good. So here's an example. Let's say you have 1,000 shares of Microsoft stock in your account. And Microsoft closed recently at about $19.66. So you have about 20 grand in value of Microsoft stock. Now, out in the market for options, you find that options on Microsoft that expire in April will be the third Friday in April. They have a strike price of 21, and they're selling for about 84 cents. Now, you can go ahead and write 10 contracts of these options, and each contract is 100 pieces. So that would be 1,000 options, and you have a complete coverage because you have 1,000 shares of Microsoft stock. Now, if the Microsoft stock stays at about 1966, whomever you sold this option to couldn't exercise the option, or typically wouldn't, and you would make all the money that that person gave you for that option. It would be about $840. Don't worry about the details of how you get the money and so on and so forth here. Anyway, let's say you do that again and again and again. Let's say you do it 6 times in a year. Then you'd make about $5,000. Plus you'd be getting the Microsoft dividend all along, and you'd make, say, $6,000 odd on a base of $20,000, or you'd make a return of about 33%. That's how you make money doing covered calls. You're basically making a gamble that the stock you hold is not going to go up. You have some conviction that the market's moving sideways, or that the market's not volatile, or equivalently, you're just willing to give up the upside on the stock you're holding. So you see, it's simply a form of market timing. You think that your stock isn't going to go up. You definitely do make some income, and then you do probably lose the upside on the stock. And then there's all kinds of rationalizations. People say, well, you don't lose any money you already have. Or they say because you have the stock in the same account that you're writing the options, you don't have to pay any margin. Or they say you don't have to worry about taxes if you do it in your non-taxable account. Or they say your losses are limited. It's not like writing an option where you don't have something covering it. Anyway, what are the flaws in this strategy? I suppose the most fundamental flaw is that if the stock goes up, you're going to lose the upside. Now, why are you holding the stock if you don't think the stock is going to go up? Again, if you think you can do timing, if you think you can discern when the stock is going to move sideways, then perhaps you could be successful. Another flaw is, potentially, when the stock goes down. What if you wake up one morning, the stock's gone way down, and you think it's going to go down more? Well, you can't sell it until you get rid of the options. A third flaw is taxes. You will almost surely lock in the highest rates of taxes. Now, a regular buy and hold strategy for stocks gives you generally the lowest taxes. You pay long-term capital gains taxes long in the future when you sell the stock. But with these covered calls, you might be forced to sell a stock. Maybe it's a stock you held for a long term and it's a long-term capital gain. Or maybe it's one you bought just for the covered call purpose, in which case it would be a short-term capital gain. Also, the premiums you get from selling the options they would be ordinary income. In general, you're going to have the highest kind of taxes if you do covered calls. Also, some people who do covered calls, they diminish the commissions, saying that they get commissions on their trades at $5.95 per whack or whatever. Sometimes those commissions might not reflect all the costs in trading. Also, another very, very fundamental flaw is that the premium you'll get for a stock will only be high if the stock is volatile. So if the stock is going to be going up a lot, then perhaps you'll get a high premium, but then you'll run the risk that you'll lose the upside in the stock. Stocks that will have very little volatility, the kind you'd be inclined to use for covered calls, will offer very low premiums in the market. Ultimately, it's an empirical question whether covered call writing works or not. I know of no successful covered call writers. I've read James Stewart's calls faithfully, and I can't tell if he's making money doing it or not. I know some high-powered investors, hedge funds and the like, they do it in a big way. Oftentimes they do it with market indexes and options and market indexes. Again, I don't know if they're successful or not. You can do it for fun and maximize utility. I have no aversion to that. You can do combinations of it. You can, for example, the Bernard Madoff operation, they were doing something like this. They were owning stocks, writing call options, and then they were buying put options supposedly, but that was all a fraud. But those combinations become very, very complicated very, very quick. Now, later I'll do a skit on why it's so useful to know that investing techniques do not work.